Let's bring in our first guest. Dan North is the chief economist at Euler Hermes North America. So great to have you here, Dan. Or maybe, sorry if I'm pronouncing it wrong, Euler perhaps. I study engineering, so I'm thinking about the Euler method here. Euler Hermes North America. Hey, what's the deal with this Fed cut? Can you give me an answer, Dan? Because I'm a little confused why the market's pricing in a more than 80% chance we cut when we've got the best new home sales we've gotten this entire recovery.
Yeah, we actually do think that there will be a Fed cut, and there, I think, a number of reasons, and I think the market is right that we'll get a cut in the middle of the year. Well, you're talking about the housing market, and certainly that's a boost. If you look back at the levels of housing compared, historically, after the housing market burst, we're still not back up to levels of maybe even 20 years ago. And new home sales, I think, have been down 3 consecutive months. So yes, housing is recovering, that's true, but there's lots of other things that are going on. Consumers, there's this ubiquitous narrative that the consumer is driving the economy. Well, that's partly true. Overall personal consumption, sure, it's positive, but it's absolutely drifting downwards. Why? 2 reasons. One, after-tax income is drifting down. We got that tax cut that boosted that after-tax income. Well, we didn't get a second one. So income is on the way down, and so are wages. Why are wages going down? Because the labor market is definitively slowing.
Okay.
Job openings are falling down. Temporary hiring is down negative. There are a number of issues that are definitely pointing to a slower labor market, and I think that's putting a drag on the on consumption. I mean, that's what Powell himself said today. So we think that there are a number of good arguments as to why. And don't forget about that yield curve. You were talking about that earlier. Well, the yield curve, the 10-year to 3-month, is the one I look at. That was inverted for 5 months last year, and it takes a year before we get into a recession. So we still have a ways to go based on that signal. We can't just ignore it.
Right.
We're not calling recession.
If I could just jump in real quick, Dan, because I want to come back to the employment point. It's a really good point. And the yield curve as well, obviously. We talked to Harvey Campbell at Duke, who basically said, look, it doesn't matter what happens after the thing inverts, recession's coming. But back to employment for a sec, because this is a crucial one. Is there still not events that need to happen between this cracks that have been forming in the employment situation to a full-on scenario where the Fed needs to cut again? Because, employment can crack. We're at the lowest unemployment rate we've gotten in 50 years. We're coming off some serious levels here.
Yeah, so that would have to back up considerably. There's no question about that, but it certainly could happen. I do think the unemployment rate is just about bottomed out. There's a wonderful model that the San Francisco Fed has built that leads the unemployment rate, and it has turned up very sharply. And again, when job openings, which have been on a 10-year upward streak, are now turning down, it's going to be harder to create more jobs when there are fewer jobs open. So we definitely see tightening in the labor market, and I think that's what's putting a lid on wages and contributing to the slowdown on income.
One of the charts you have that I do really like that is pretty compelling is looking at confidence, because I was mentioning at the top of the show, this is one that's always kind of a double-edged sword. Are people too confident? They're confident as heck. Sentiment this week was great. But the question is, are their expectations now too high, or, how do we look at this? Because you're basically looking at a spread here between the present and future, and I think this is pretty interesting.
Right. So the Consumer Confidence Survey asks a number of questions, and one of the questions is, how do you feel about things now? And that's that tan line that's very high, the present situation. Then they ask about, how do you feel about things in the future? And that's that green line. And obviously they're diverging very sharply. And when you get that big of a divergence, that's the blue line on the right. That's the difference between those. When you can clearly see when that blue line goes down that far, it's always associated with a recession. The interpretation is basically, when people are worried about the future, they're usually right. And I think that the consumption's being driven off really more by those future expectations. Consumers often say one thing and do another.
Yeah.
But I think those future expectations are probably the real worry there.
The thing that jumps out to me, because if we were to argue about these compressed cycles, I know that's one of the big topics, is whether or not the Fed has narrowed our boom and bust cycle. In 2015-16, you can see on the chart that this gap closed by future expectations moving higher. What's to stop a repeat as we came out of that little mini recession?
Well, yeah, that would be happening after the recession. I mean, that's the pattern. Surely, after a recession's over, people say, "Okay, things are going to get better." I don't feel things are great now. You can see over on the left chart, all the way to the left, after the recession, is exactly what happened. So it surely can reverse, but we have to get through a downturn. And again, I've been saying recession. We're not forecasting a recession.
Okay.
We're definitely forecasting a slow year of about 1.6% GDP growth.
Okay, so the cut that's right now, December, 84%, I think I checked. By June or July, it's around 50-ish. What are the incremental things that need to happen between now and then to really confirm that? Just worsening of this data, because it seemed like the situation for the Eurozone and China was getting better here the last quarter. City economic surprises beaten at the fastest rate for those two regions in 2 years. So do we need to watch those areas for the green light on a cut?
Well, sure, that's always important. It's important to realize as well that the U.S. really isn't an export-driven economy. For all the talk about trade, we're driven really more by domestic activity. So, yeah, it's important. It's a little bit less important as to what we see here. But, you know, you're asking what are the triggers? And again, what I see is an absolute decline in consumption driven by a slowdown in the labor market. And I think, you know, we're going to see that effect of the inverted yield curve. Again, people ignore it because it's already gone positive again. That's exactly what happens in the past 7 recessions. That's exactly what happens in the past 5 times. Goes negative, goes positive, then you get a recession. So I do think that there's some drag there. And again, that fiscal policy, the other major tool where we got that tax cut, we don't get one. So there's not a lot of oomph that's being produced for the economy there. So I think there's some pretty big drags on the trade situation. You know, we got that phase 1 deal, big deal. Most of the tariffs are still in place. Okay. And that is certainly a drag.
All right. Dan, let's continue the conversation. Really good stuff. Looking forward to having you back. Dan North, Chief Economist at Euler Hermes North America.